How do you close out a ratio put spread position? If you are curious about how to close out a ratio put spread position, you are in the right place. Let's break it down step by step. A ratio put spread involves selling more put options than you buy. To close this position, you need to execute the opposite transactions of your original trades. First, you will need to buy back the short put options that you initially sold. This is important because you want to eliminate your short exposure. Since you sold more puts than you bought, this step is crucial. Next, you will sell the long put options that you originally purchased. This action offsets your long put position. It is essential that both sets of options have the same strike prices and expiration dates as your original spread. By doing this, you neutralize your position, effectively eliminating both the long and short put contracts. To start, identify the strike prices and expiration date of the puts you bought and sold. Once you have that information, place an order to buy to close the short puts. These are the ones you sold in greater quantity. Then, place an order to sell to close the long puts, which are the ones you bought. You have the option to close the entire position at once or close parts of it separately. This choice depends on your trading goals and the current market conditions. Timing is also an important factor. Closing your position before expiration can help you avoid assignment risk on the short puts. It also allows you to lock in profits or limit losses. Keep an eye on the market price. The cost to buy back the short puts and the proceeds from selling the long puts will determine your net closing cost or credit. Additionally, market volatility and the underlying price can affect option premiums, which will influence your closing costs. Risk management is vital when dealing with ratio put spreads. If the underlying price falls significantly below the short put strikes, you could face undefined risk. Closing the position can help prevent large losses in such scenarios. In practice, traders monitor the underlying stock price relative to the strike prices to decide when to close. If the stock price moves unfavorably, it may be wise to close early to limit losses. If the stock price is near the short put strike at expiration, you can either close the position or allow it to expire based on your outlook. In summary, closing a ratio put spread means reversing your original trades. You will buy back the short puts and sell the long puts with matching strikes and expiration dates. This process eliminates your exposure and realizes any remaining profit or loss.